You've probably seen the headlines without really seeing what they mean. Billionaires trimming their stakes, founders unloading stock, CEOs rebalancing at all-time highs. And every time you're handed the same soft explanation, it's just diversification, just tax planning, just philanthropy, nothing to worry about. But what if that's the comfortable lie? What if the truth is that the people with the best information in the world are quietly stepping off the ship while everyone else is still dancing on deck? Between early and late 2024, the world's richest insiders didn't just sell a little. They dumped tens of billions of dollars worth of shares into the market. Not slowly, not randomly, but in concentrated waves. Jeff Bezos pushed out a mountain of Amazon stock. Mark Zuckerberg sold Meta month after month. The Walton dynasty offloaded chunks of Walmart. Larry Ellison lightened up on Oracle. NVIDIA's insiders fed shares into the AI mania they helped ignite. And Jamie Dimon, the man who wore "I never sell" like a badge of honor for almost 2 decades at the top of America's biggest bank, finally crossed the line and joined them. These people are not gamblers. They are not trading off TikTok sentiment. They built trillion-dollar machines from scratch, steering them through the dot-com bust, the housing collapse, the euro crisis, the pandemic. They have seen real crashes, real panics, real recessions. They don't hit the eject button for fun. So when the same group starts making the same move at the same time, you have to ask a very simple question. What are they seeing that you don't? This film is not about scaring you with a date and a number. It's about showing you a pattern. First, we'll walk through what insider selling actually is and why it's one of the purest signals we have. Then, we'll break down the 5 historical patterns that keep showing up before markets crack. After that, we'll map those patterns onto 2025 and 2026, the window where the pressure from valuations, debt, and tightening liquidity all collide. Finally, we'll talk about who quietly wins, who gets wiped out, and what a normal person can do without pretending to be a hedge fund wizard. This is not fortune-telling. It's pattern recognition. And the pattern right now looks uncomfortably similar to every major top of the last 50 years. Start with the basics. An insider isn't some anonymous source on a forum. It's the people who sit at the core of the company you own. Founders, chief executives, chief financial officers, directors, anyone who has access to information that doesn't show up in a quarterly press release. By law, when they buy or sell their own stock, they have to file it with regulators within 2 business days. Those filings are public. They're just buried where almost nobody looks. Why do they matter? Because insiders don't see the world the way you do. You read an earnings summary every 3 months. They see the numbers breathing every single day. Jeff Bezos doesn't sit around waiting for an analyst note to tell him how Amazon is doing. He can watch orders in real time across continents, see when a region cools off, when a product line's profitability is slipping, when the cost side is creeping up ahead of schedule. Jamie Dimon doesn't need a government report to tell him about the economy. As the head of J.P. Morgan, he sees loan delinquencies as they start to tick higher. He sees which sectors are quietly in trouble. He sees office buildings rolling loans at higher rates and failing the math. So when those people decide, I don't want to hold as much of this stock anymore, it isn't a random whim. Yes, sometimes they sell for normal reasons, a new house, a divorce, taxes, a charity pledge. That's why looking at one transaction in isolation doesn't tell you much. But when you zoom out and see the whole cluster, who is selling, how much, and when, the story changes. To make sense of that cluster, researchers use a simple gauge. How many dollars insiders are selling versus how many dollars they're buying. If, across the market, insiders are selling twice as much as they're buying, that's normal. Executives get paid heavily in stock. They naturally sell some to diversify. A ratio around 2 or 3 to 1 is just the cost of living rich. When that ratio drifts up toward 5 to 1, it says insiders are getting a bit more cautious. But historically, the real signal has been when that ratio blows past 8 to 1 and stays there. At that point, insiders aren't just casually lightening up. They're all gravitating to the same side of the boat. That's exactly what's been happening. In 2024, insiders sold roughly $9 worth of stock for every dollar they bought. In some months, that imbalance went even higher. You don't need a PhD in finance to understand what that means. The people with the best information, the most context, and the most to lose if they're wrong, are overwhelmingly choosing to convert shares into cash rather than the other way around. Now put some faces and histories on that ratio. Jeff Bezos has been tied to Amazon since it was a crazy little online bookshop in the mid-1990s. Over 30 years, he's seen the dot-com bubble inflate and explode, watched Amazon lose 90% of its value, and then become one of the most dominant companies in human history. He's seen the 2008 crisis, the COVID crash, interest rates at 0 and at multi-decade highs. He's sold stock before, yes, especially to fund rockets and side projects, but never in a concentrated wave like he did in 2024. This time, he lined up plans to unload huge blocks of shares into a market that was already near record valuations, compressed the selling into tight windows, and took billions off the table in a matter of months. The official story pinned it on state taxes. He moved to a tax-friendly state. Therefore, he sold. Convenient. But think about the timeline. Bezos has been one of the richest men alive for more than 2 decades. He could have optimized his tax residence at any point along that path. He waited until Amazon had become a multi-trillion-dollar giant and the broader market had been inflated by years of cheap money and AI hype. He's not just saving on tax. He's crystallizing gains at prices he does not expect to last forever. Mark Zuckerberg tells a similar story in a different key. Meta nearly got written off in 2022. The stock plunged as investors questioned the metaverse gamble and advertising growth. Then came the pivot. Cost cuts, AI, efficiency. The share price didn't just recover, it went vertical, multiplying several times from the lows. While the public narrative focused on the comeback, Zuckerberg quietly turned on the selling machine. Month after month, prearranged plans pushed hundreds of millions of dollars of Meta stock into the market. By the end of 2024, the total ran into many billions. Publicly, it's all for charity. The Chan Zuckerberg Initiative. Social good. Long-term missions. But again, look at the mechanics. Zuckerberg holds special shares that give him control with relatively little economic ownership. He doesn't have to sell to stay in charge. He doesn't even need to sell to raise money. He can borrow against his holdings with extremely favorable terms. Yet, he chose to dump substantial chunks right as the stock traded at euphoric AI valuations. That's not what you do when you believe the next 5 years will make today's prices look cheap. And then there's Jamie Dimon. If you had to pick one person whose actions are worth more than 1,000 macro think pieces, it would be him. For nearly 19 years as CEO of JP Morgan, he built a persona around alignment with shareholders. He told the market that CEOs who constantly sell send the wrong message. He let his own compensation ride in stock through every crisis. And then, in 2024, he quietly crossed the line and authorized his first meaningful sale. The excuse: estate planning, family diversification, sensible housekeeping at his age. The deeper reality: the man with the best view into the plumbing of the global financial system decided that holding every last share through the next cycle no longer made sense. You can ignore one insider selling. You can ignore 5. But when the most disciplined, long-term holders of the modern era, people who have held through 3 decades of market storms, start selling in the same year, in the same sectors, while valuations are stretched to extremes, that's not noise. That's a signal. And if you understand how these cycles work, you know that signals don't flash at the bottom. They flash near the top, right before the air gets thin. The next question is simple. Does history support this level of insider urgency? The answer is brutally consistent. Across the last half-century, 5 patterns appear before every major market breakdown, and right now, all 5 are lighting up at once. The first pattern is timing. Insiders never sell at the bottom. They sell during the final stretch, 6 to 24 months before the market peaks. They sell when prices look strong, when optimism is high, when momentum is still positive. Look at the timeline. In 1987, insiders unloaded heavily through spring and summer. The crash hit in October. In 2000, insiders sold aggressively through late 1999 and early 2000. The Nasdaq peaked in March before collapsing 78%. In 2007, insiders dumped record amounts while indexes drifted higher. By October, the market topped, and the 2-year slide into the Great Recession began. Why this timing? Because insiders feel stress in the system before the public does. They hear credit markets tighten, they see sales slow, they see defaults rise, they see cost pressures forming. They feel when optimism exceeds reality. They don't wait for headlines. They act when their own dashboards tell them the picture is turning. By the time earnings reports reflect that weakness, the damage is already done. The insiders are long gone. The public is still buying. Then suddenly the narrative breaks. Pattern 2 is the sell-to-buy ratio. This is the cleanest indicator of insider sentiment we have, because it strips out excuses and focuses on action. Every year since 1975, analysts have tracked how many dollars insiders sell versus how many dollars they buy. A ratio of 2 or 3 to 1 is business as usual. A ratio above 5 is elevated. A ratio above 8 is dangerous. And a ratio above 10, that's historical disaster territory. In 1987, the ratio spiked near 10. Crash. In 2000, it surged into double digits. Crash. In 2007, it hit extremes never seen before. Crash. And now, in 2024, the ratio sits around 9 to 1 for the year. In certain months, it exceeded 12 to 1. That is the exact zone, mathematically, historically, and psychologically, where insiders have screamed the same message: we're out. Pattern 3 reveals where insiders are selling. Before the dot-com crash, tech insiders were the first to exit. Before 2008, financial executives quietly dumped shares while the public still believed in ever-rising home prices. The insiders always leave the most inflated sectors first because those are the sectors where the fall will be the sharpest. Look at 2024. Where is the exodus happening? Tech and financials. The two sectors priced for perfection and exposed to enormous downside. Tech valuations are built on AI euphoria, assumptions of unlimited growth, flawless execution, and cost curves that defy economic gravity. Financials are sitting on silent time bombs. Office buildings that no longer have tenants, commercial mortgages that can't be refinanced, loan books that are cracking at the edges. Insiders in both sectors are selling, not trimming, not diversifying, selling. That's not a coincidence. That's the same pattern we've seen in every speculative blow-off of the last 50 years. Pattern 4 is psychological. Some insiders trade frequently. Their sales don't mean much. But when the most loyal holders, founders, legacy CEOs, long-serving leaders, when they sell, that's different. Bezos held Amazon through crashes that wiped out 90% of its value. Zuckerberg held Meta through the darkest days of the privacy backlash and lockdown chaos. Jamie Dimon held JP Morgan through 2008, 2011, 2020. These are not short-term thinkers. These are men who bet on their own creations against impossible odds. When they choose to reduce exposure, they're not reacting emotionally. They're responding to numbers we haven't seen yet. And pattern 5 is the final one, the killer metric. When insider selling exceeds $400 billion in a year, the market does not make new highs for years afterward. This has held true every single time since the metric was created. After 1987, new highs took 2 years. After 2000, new highs took 7 years. After 2007, new highs took 6. And now, insider selling in 2024 is around $464 billion. If 2025 continues accelerating, it may exceed even the 2007 peak. That means if the pattern holds, and it has held for half a century, the odds of the market pushing meaningfully higher in 2025 or 2026 are extremely low. The risk isn't that prices drift sideways. The risk is that prices collapse 40–60% before recovering. Which brings us to the next critical question. What exactly are the insiders seeing that the public is not? Start with valuations. The Buffett indicator, total market capitalization divided by GDP, is Warren Buffett's own preferred barometer of market froth. Historically, fair value sits around 8,100. Above 120%, the market is expensive. Above 150%, bubbly. Today, it's hovering near 180%. To justify those prices, you'd have to believe the economy will suddenly accelerate to sustain record growth, or that corporate profit margins will rise into fantasy territory. Neither is happening. Growth is slowing. Margins are already stretched. This ratio must revert to the mean, and mean reversion implies a 40–50% correction. Then, there's the Shiller PE. Adjusted for inflation and cycles, the historical average is around 16. Above 30 is bubble territory. Today, it's above 34. Only 3 times in history have valuations been this extreme: 1929, 2000, and 20. None ended gently. Margin debt is the next landmine. Investors have borrowed nearly $1 trillion to buy stocks at inflated prices. When the market rises, leverage magnifies gains. When the market falls, leverage forces selling. Margin calls create liquidation cascades, selling that triggers more selling until the market hits a hard stop. In 2008, forced deleveraging accelerated the crash. Today, margin debt is even higher. Then you have commercial real estate, the invisible disaster. Office towers in major cities are half empty. Remote work collapsed demand. Buildings bought at 3% interest rates now have to refinance at 7–8%. Values have cratered, but the loan maturities are coming due in 2025 and 2026. This isn't priced into stocks yet, but insiders see it in real time. They know which banks have exposure. They know which loans won't roll. They know where the contagion starts. Corporate debt is another ticking clock. Companies borrowed trillions at near zero rates from 2010 to 2021. Now, those bonds are maturing. They must be refinanced at rates double or triple what they were issued at. Many companies simply can't survive that transition. Bankruptcy rates in 2024 reached levels not seen since 2010. That's the early wave. The main wave hits in 2025, 2026. And then there's the federal debt spiral. The U.S. government owes $36 trillion. Interest payments alone are now over $1.2 trillion per year, more than defense, more than Medicare. If rates stay elevated, interest hits $1.8 trillion by 2027. That's unsustainable. The only outcomes are higher taxes, severe spending cuts, or massive money printing. None of those outcomes are friendly to stocks. The insiders know this. They're not reading headlines. They're seeing the raw input streams. They're seeing weakening demand. They're seeing margin compression. They're seeing early credit stress. They're seeing the pressure points forming months before the public will. And they're acting on it. The public is doing what it always does. Chasing momentum. Believing in narratives. Assuming that because yesterday went up, tomorrow will too. But insiders are not betting on hope. They're betting on math. And the math is ugly. So now comes the question the public never asks until it's too late. When does the break actually happen? Because insider selling doesn't time the exact day of a crash. It times the window. It marks the zone where the foundation has already cracked, but the surface still looks polished. Historically, the lag between peak insider selling and the market's reversal is 6 to 18 months. That's the danger zone. In 1987, insiders sold aggressively in spring and summer. The crash hit in October, about 6 months later. In 2000, insiders unloaded heavily in late 1999. The Nasdaq began its fall in March, almost immediately. In 2007, the heaviest selling appeared through the year. The market topped in October and then slid into the deepest financial crisis since the 1930s. Again, the lag was within a year. Apply that pattern to 2024. If insider selling peaked through mid and late 2024, the window of vulnerability lands squarely in Q3 2025 through Q2 2026, a 12 to 18-month corridor where everything lines up. The refinancing cliff, the commercial real estate failures, worsening consumer credit, rising corporate defaults, and the mounting pressure from a federal debt problem that no longer has a painless solution. But there's more. Election cycles intensify instability. Historically, markets prefer certainty, and year one of any presidential term tends to be turbulent. If 2025 marks the start of a new administration, or the volatile continuation of an old one, investors should expect instability, not comfort. Year two is often when delayed economic pain finally arrives. That puts 2026 in the crosshairs. You don't need a perfect catalyst to predict the slide. Fragile systems don't need a big shove. They just need a crack in the wrong spot. In 2008, a single hedge fund freezing redemptions triggered panic. In 1987, computer-driven selling turned a dip into a collapse. In 2000, earnings disappointments turned momentum into an avalanche. Today, the trigger could be almost anything. A regional bank failure, a commercial property fund going under, a corporate default that exposes hidden leverage, a geopolitical shock. The point isn't what lights the match. The point is that the room is already filled with gasoline. The insiders know exactly how this movie plays out. They've watched it from inside the control room. They know what breaks first, and they are not positioning for more upside. They are positioning for survival and advantage on the other side. So who wins when the music stops? First, the insiders themselves. Jeff Bezos selling Amazon at 170, 180 doesn't just lock in profit. If Amazon falls 50%, he can buy twice as many shares with the same cash. That's how dynasties consolidate power. Zuckerberg selling billions at $450, $500 can buy the same empire back at $225 at $250. Jamie Dimon selling JP Morgan at $155 at $106 can reload at $95 $100 if financial stocks correct. These men won't just survive the downturn, they'll expand their dominance because they sold into strength while the public bought the top. Second, people holding cash win. Cash is oxygen during a fire. When forced sellers dump stocks at any price to meet margin calls, cash becomes the most powerful asset in the world. In every crisis, 1987, 2000, 2008, 2020, the greatest fortunes were made not during the boom, but during the collapse, by people who had dry powder while everyone else was suffocating under leverage. Third, people holding gold win. When systems break, when debt spirals, when central banks are forced to print to stabilize the core, gold doesn't rise because of optimism. It rises because of fear. In 2008, 2011, gold doubled. In 2020, 2021, it surged again. In the next crisis, the Fed will not be able to cut rates to zero without detonating inflation, so they will print strategically, surgically to stop credit markets from imploding. That money printing will weaken the dollar. Gold will do the same thing it has done for 6,000 years, preserve purchasing power while paper systems wobble. Fourth, patient long-term buyers win. You don't need to be a genius. You don't need to predict the exact bottom. You need a list. Apple, Microsoft, Visa, Costco, Johnson & Johnson. Companies with fortress balance sheets and sustainable cash flows. When panic slashes their prices 40–50%, buying gradually on the way down has built more wealth than any hot pick ever could. But who loses? The middle class. The people whose net worth sits almost entirely in home equity, savings accounts, and retirement portfolios. The people who rode the market up because it always goes up, without realizing that the people who know the system best quietly left at the top. If you have a 401k heavily weighted in index funds, if you're nearing retirement, if you don't have 20 years to recover, a deep drawdown is not an inconvenience. It's a life-altering event. $1 million becomes $500,000. A planned retirement becomes a forced delay. This is the tragedy hidden behind the market's optimism. Pension funds lose. Major pension systems are leveraged to market performance. When markets drop 40–50%, pensions become underfunded, benefits get cut, retirees suffer, municipalities enter crisis. Insurance companies lose. Their balance sheets rely on stable bond markets and diversified equity exposure. A liquidity shock threatens solvency. Leveraged investors get obliterated. If you borrowed money to buy stocks, margin, options, leveraged ETFs, you are handing the market a loaded weapon pointed directly at your portfolio. Margin calls don't care about fairness. They don't care about your conviction. When prices fall, brokers liquidate you at the bottom while insiders buy back at discounts. This is the structural wealth transfer that happens every cycle, from the overexposed to the prepared, from the hopeful to the informed, from the public to the insiders. So what should you do, right now, before the window closes? First, reduce exposure. If you're 70–80% in equities, bring it down. You don't need to sell everything. You need to control risk. If the market rises another 10–15%, you won't miss much. But if it falls 50%, you'll have preserved what others lose. Second, raise cash. Cash is not an investment, it is an option to buy when everyone else is forced to sell. Third, hold 10–20% in gold, physical or ETF. Gold is not for growth, it's for protection. Fourth, prepare your buy list now. When the crash comes, you won't have time to think. Fear will dominate. The crowd will panic. But if you already know what you want to own, and at what prices, you can act while others freeze. Fifth, protect your job and build an emergency fund. Crashes come with layoffs. A 12-month cash buffer gives you freedom not to liquidate assets at the worst moment. Finally, prepare psychologically. Crashes are not just financial events, they are emotional storms. Your portfolio falls, your friends panic, the news screams, everything in your brain tells you to sell. But that's the moment opportunity is created. Not at the top, at the bottom. Every crash is a reset. Every reset is a wealth transfer. Your job is to stand on the right side of that transfer. Let's end with the truth that nobody on TV will say out loud. The billionaire exodus is not random. It is a coordinated, data-driven, historically consistent signal. More than $50 billion from the world's richest founders. More than $460 billion in total insider selling. A sell-to-buy ratio near the danger zone. Valuations at extremes. Debt pressures converging. Commercial real estate deteriorating. Corporate balance sheets cracking. Federal finances losing stability. This is not fear-mongering. This is pattern recognition. And the pattern says the window between late 2025 and mid-2026 is the most dangerous since 2007–2008. Maybe the market limps higher before then. Maybe it even makes a marginal new high. But the insiders have already voted with their actions. They are not early unless they're wrong. And they're not wrong unless the laws of cycles suddenly stop existing. If this documentary showed you something you didn't see before, if you now recognize the pattern forming beneath the surface, then you know what comes next. Prepare, protect, position. The billionaire exodus has begun. The pattern is complete. The clock is ticking.